This is a major setback for the PE industry, not only in that it casts great doubts on the enforceability of the preferential treatments these local government rules have given to the market, but also on the it shows to the industry the conflict between the central government and the local governments. From a practical perspective, we have always been telling our clients there are limitations in these local rules, in that once you are out of the territory, there's great doubt as to how you will enforce these pilot programs in, say, for example, other provinces. There's no doubt about it. I think the major attraction of the pilot programs are the most important thing is that they have this national treatment, so that they can get around the onerous approval process. And now that this is so-called abolished or denied by the central government, it's very doubtful that this is going to be enforceable. And plus the the slow process in the currency conversion front with SAFE and the tax clarity, I think it's going to be very difficult, or even more difficult for the foreign-backed RMB funds to fundraise in China. The RMB fund fundraising on the RMB fund side still constitutes 75% of the total assets fundraised as of 2011, and in April it's even higher. So I think the market will still continue to go strong, but given the soft market and it's getting the difficulties that the market is experiencing both in the Chinese market and also in the Hong Kong and US markets, I think because most of these RMB funds still expect IPO to be their exit strategy, that will make it more difficult. And so as a side product, I think the other alternative way to exit, which is the acquisition and the mergers, will probably become more available, or used by more funds. Unfortunately, I do think that there are managers who are simply taking a chance and ignoring this very important piece in their life. I think from a legal perspective, the consequence of ignoring it is that even if you're ignoring it, the SEC, the US SEC, will still have jurisdiction over a foreign manager, especially who are fundraising in the United States. So there's no way to escape. And believe it or not, they are talking to regulators of various countries. But putting that aside, from a business perspective, once a manager is sanctioned by the SEC for non-compliance, it casts great doubt in the market and it hurts the reputation. And nobody would, or a lot of people, especially reputable LPs, would not want to do business with this manager. Usually in the legal document, there is a representation made by the GP to say that it is in compliance with applicable law. So even though under the U.S. Advisors Act there's no private right of action, the LPs do not have a right to sue the GP for not registering with the SEC or in compliance. They can sue, or they can make a claim for breach of contract.